Good afternoon, and welcome to our webinar on solving the mystery of charitable planning. Proper planning plays a significant part in our financial well-being. And of course, we're all glad that you could join us today for this discussion on this very important topic. My name is Philip Keefe, and I'm the Director of Advancement here at Patterson Habitat. Before we start, I'd just like to finish up with some housekeeping. We have a good number of folks registered for today's session, so please ask any questions you have using the Q&A function on the screen, and we'll try and address as many questions as possible. Today's program is being recorded, and I'd just like to take a quick moment to thank a special group of folks who are, some of them are on this webinar right now. They're part of the Legacy Society here at Patterson Habitat, and these are people who have had the forethought to name Patterson Habitat in their estate plan. Perhaps these donors have named Habitat as a recipient of their bequest, or a bequest, I should say, in their will or living trust, or perhaps they've named Patterson Habitat as a recipient of all or part of their retirement plan, such as an account at Vanguard or Merrill Lynch, TIA, CREF. They may have opened a charitable gift annuity or a charitable trust, or named Patterson Habitat as a recipient of a life insurance policy. So as these concepts are an important part of our overall legacy planning, we have the wonderful opportunity to hear from Larry Holzberg and Rufus Davenport to explain the importance of protecting your family's future by planning correctly. I'm proud to introduce these gentlemen. Larry has over 30 years experience in the financial services industry. I believe you're still serving as president of the National Association of Insurance and Financial Advisors. And Rufus is a chartered financial analyst with over 15 years of experience in financial services. So it's now my pleasure to turn the presentation over to Larry and Rufus.
Thanks very much, Phil. Good afternoon, everybody. It's a pleasure to be with everyone. And I hope you find this is educating, and feel free to raise your hand in the chat box for any questions that may come up. And we look forward to getting to you. Topic is today, charitable giving, helping you make a difference. Next slide. We are financial professionals specializing in helping individuals and families make the most of their income and assets to achieve their financial goals. These goals often include making sure their family income is protected, planning for a comfortable and secure retirement, leaving assets to children or grandchildren, and in many cases, supporting their favorite charitable organizations, like many of you do already. As you might imagine, our clients are committed to achieving the financial goals they set for themselves and their loved ones. The discipline with which they have approached their finances often puts them in a position where they have the ability to make significant gifts to a charity both during life and at death. People give to charity for many reasons. Why do you give to charity? I know it makes me feel good. It knows I help the organizations that I care about, and allows me to give that warm feeling inside of doing a good job. Do you want to help others? Set a good example. Maybe you have a personal connection you have to a loved one inspired you to give. Were you raised to give back a portion of your good fortune to those in need? Most give because it adds value to quality of their lives. In simpler words than those used here by Winston Churchill, it makes you feel good. Before we begin, let me ask some rhetorical questions regarding the planning process. Are you involved with a charitable organization? Obviously, if you're on this call, you are. How much do you contribute now? How much do you volunteer now? How do you volunteer? What legacy do you want to leave? Are you aware of the variety of charitable giving strategies that you can use to support your charity? Have you discussed charitable giving with your financial professional, tax, and legal advisors as part of your financial estate plan? Making significant gifts to charitable organizations can be complex. So we urge you to obtain tax guidance. As you may be aware, you may also be able to receive tax benefits as a result of your gift. The tax implications of giving may become more significant depending on the size of your gift and the type of gift you donate. By the way, we are aware that you may be able to donate items other than cash to the charity. People can give stocks, investments, shares of their business, real estate, insurance policies, even artwork or other collectibles. Non-cash gifts often have additional requirements that make them more complicated, but they may ultimately provide a greater benefit to you and or the charity. So it's worth having a professional evaluate. With the tax changes in 2017, there's a higher standard deduction. A charitable deduction is only allowed for the taxpayers that itemize their deductions, and the increased standard deduction, as well as has capped some itemized deductions as mortgage interest and state and local taxes. As a result, itemized deductions may not exceed the standard deduction, and these taxpayers may not benefit from their charitable deduction. There are, however, strategies that may address this impact, such as bundling several years of charitable deductions in 1 year. Clients should work with their tax advisors and financial advisors to discuss these strategies. It is also important that an attorney skilled in philanthropy and estate planning in your state drafted documents to reflect your wishes. Understand your legal matters. Make sure your attorney can help you understand the intricacies, benefits, and risks associated with your plan given. Protect your priorities. Make sure any donation you give will not put your other goals at risk. It's also important to recognize that all non-cash gifts greater than $500 require some form of a receipt from the charity, and gifts greater than $5,000 require a qualified appraisal by an independent appraiser be filed contiguous with the gift as to ascertain the fair market value of the gift. And we can get you the IRS publications for the details if you'd like that. Next slide, please. Gifting strategies. Some of the things we're going to be considering. Charitable planning strategies include direct outright gifts of cash and property during the lifetime or at death. No, you do not want to actually transfer. Let me say that. No, you do not want to actually transfer a retirement account to a charity or anyone else during lifetime, so it would be treated as taxable. Direct gifts are certainly easier and less complex. Generally, the donor, the party making the gift, will be able to receive an income tax deduction subject to the IRS rules and requirements. Those rules and requirements look at the type of property transferred and the type of charity. So we're going to discuss these and go into greater detail as we go on. Next slide, please. Gifting with life insurance. Another asset clients ask about gifting to charity is life insurance. For some of them, the reason they purchased the policy is no longer applicable to their current situation. Others are simply curious if there's a way that a life policy can supplement their annual gifts. There are several ways life insurance can be used to provide meaningful gifts to charity during your lifetime, or at death. For permanent policies, dividends, the cash value, or the entire policy may be gifted during your lifetime. The charity may also be named the policy beneficiary or on either term or permanent life insurance. There's no minimum amount that may be given, and you may choose to gift up to the full policy death benefit. The donor may be eligible for income tax deductions if the charity receives a benefit during your lifetime. The flexibility of gifting with life insurance is certainly an advantage, but for clients who gift life insurance, another reason they tend to like using their policies gifting is because life insurance is not part of any public record, and the feature can help them give them more privacy. Next slide, please.
Hey, Larry,
Sure.
just a question on life insurance. You said, and maybe I missed it in there, the charity should be listed as the beneficiary or the owner of a.
You can do it both ways, which I'm going to go into a little more detail. I could have a life insurance policy, like, as you mentioned, I'll be president of NAFID in January 1st, 2021, and I've been involved for my whole career. I have them as a partial beneficiary on one of my policies. They don't know that because it helps my life expectancy. I'm only kidding. So one way is just to name them as an outright beneficiary. There's really no tax deduction for that. There'll be a beneficiary. There would be a tax deduction for my estate tax if I had that problem. But I'll go on, and I don't cover the other approaches to doing it. I'll definitely answer that question. So a donor can also make a significant charitable contribution by simply naming the charity, as I just described, with myself as a beneficiary of some of all the policy death benefit. The policy owner will have access to the policy values, cash value, and dividends by borrowing or surrendering additions during his or her lifetime. He or she can make gifts of some of these amounts as well, the cash values. There are implications to borrowing from the policy. Loan interest is charged on amounts outstanding. When you borrow from your policy, the cash value and death benefit will be reduced until the loan is repaid. There may also be tax consequences if the policy lapses. Again, that's only a concern if the policy is still owned by the grantor. No income tax deduction will be allowed for premiums paid where the donor has retained incidents of ownership in the policy, and the death proceeds will be included in the insured's gross estate. However, a full estate tax deduction can be obtained for total proceeds payable to a qualified charitable organization. So this is just a simple way. First way we're covering it is I own a policy and I name, for example, Habitat as my beneficiary. There's really no tax benefit to me. There's a gift that the charity will receive at my passing. And several times when that happens, the charity doesn't even know it until the passing of a person. We actually had a member of our national association pass away last year, and part of they left $25,000 to the association. We did not know it until their passing. Next slide, please. Gifting with life insurance. Charity owns life insurance on your life. So the charity is designated as the owner and beneficiary of a new policy. The donor applies for a new policy and designates the charity as the owner and beneficiary. An amount equal to the premium is contributed to the charitable organization each year. The charity can use these funds or other funds to pay the premium. No, There also, I'll note this, insurers limit the amount of death benefit that can be underwritten based on the giving history of a donor. We've really not had a problem ever getting the amount they want issued. The donor receives income tax deduction for the cash contributions to the charity subject to the IRS charitable rules and regulations. The charity receives the death benefit if the policy remains in force, and the charity has access to the cash values as they build. So essentially, if I'm buying a life insurance policy for the benefit of Habitat, and Habitat owns the policy, and let's say the premium's $10,000, so I donate $10,000 to Habitat. Habitat writes a check to ABC Insurance Company. My charitable contribution that year is $10,000, but I'll be leaving a much larger gift in kind because of the leverage of what life insurance can do. Next slide. Gifting with retirement accounts. Let's begin by talking about gifting some of your retirement account assets during your lifetime. Some clients have retirement income they will never need, yet they are forced to take their required minimum distributions, RMDs, at age 72. Note, you generally never want to gift the actual account because of the income tax implications. The first step of gifting from your retirement account is to withdraw funds from the account. The withdrawal may be part of your RMD or an optional withdrawal. In general, any money withdrawn from a retirement account will be subject to income tax. However, there are a few exceptions. If you made an after-tax contribution to your retirement plan, a portion of the withdrawal that represents after-tax contributions will be non-taxable. Roth 401ks or Roth IRAs, qualified distributions from retirements, are income tax-free as of today. You may use the after-tax proceeds of your withdrawal to help make your charitable donation. The gift itself can be as small or as large as you like. You may claim an income tax deduction in the year the donation is made. A cash gift to a public charity generally produces the largest federal income tax deduction. Under the Tax Act of 2017, cash gifts to public charities can be deducted up to 60% of adjusted gross income. This provision will sunset December 31st, 2025, if there is no additional congressional act. Also under the CARES Act, although this is passed, those who do itemize the limit on the amount they can deduct for charitable contributions was raised in 2020 for up to 100% of their adjusted gross income. If you exceed the 60% limit, they may carry these over and take them over a 5-year period. Next. One thing that can concern clients who make significant gifts is making sure their generosity doesn't leave family members in need of future income. Having life insurance in place can help, and part of the retirement account withdrawal may be used to help pay the premiums to secure a life legacy. What that's essentially saying is when you take your RMD and you donate similar amount to charity, you're going to get a tax deduction. So what you're doing is you're lowering the value of your estate and your legacy. So you take a portion of that and you buy a life insurance policy, you can replace that legacy for a less expensive amount because of the cost of life insurance. So you're passing on a legacy income tax free to your heirs. And you can also set it up in such a way that it's outside of their estate and estate tax free if they have large estates. Next one, please. Charitably inclined taxpayers who are 70 and a half or older have the opportunity to make qualified charitable distributions. This is a direct distribution from their traditional IRA to eligible charitable organizations. The taxpayer may exclude the amount distributed directly from the IRA custodian to one or more public charities from their gross income. No charitable income tax deduction is allowed, and there is a $100,000 annual cap. This distribution will count toward their required distribution requirements. Let me try to put that in simple English. You have to take your RMD this year. Let's say your RMD from your IRA is $50,000. You don't want to pay taxes on the $50,000. You don't want it to come in. If you have that $50,000 go directly to Habitat, that will suffice your RMD, and there will be no taxable event because it went directly to Habitat, but you do not get a tax deduction. So you've not recognized the income, but you don't recognize the deduction, which is fine. And also, if you're not taking deductions or using standard deductions, you wouldn't qualify for the income tax deduction. So making a direct contribution from your IRA to the organization can be one way for you not to have to pay taxes on the RMDs, satisfy your RMDs. And as we discussed in the example before, if you want to make your family whole or your legacy whole, you can purchase a life insurance contract to offset what you're giving in RMDs. Next slide. Creating a charitable legacy. Regarding beneficiary designations, designating a charity as a beneficiary of your retirement account is another way to make a gift. Your retirement account can help you leave a legacy to charity. All that is required is to change the account beneficiary to the charity. You can typically change the beneficiary as often as you like, so it is very flexible. In many cases, and if you want to stay happily married, you will need the written permission of your spouse to do this if you are married. So if you are married, your spouse should sign off on that as well. Keep in mind with this method, the charity does not receive any donation until after your death. That means the charity must wait to use it to support their initiatives, and there is no income tax deduction. You can name the charity a beneficiary of the entire account balance or just a portion. Alternatively, the charity can be named a primary beneficiary of the account or a contingent beneficiary. A contingent beneficiary will receive the designated portion of the account only if you outlive the primary beneficiary. So for that example, my wife's my primary beneficiary, Habitat's my contingent. My wife passes away, then I pass away. Habitat would receive the funds. Some other gifting strategies a little more advanced. Retaining income strategies. Charitable planning strategies include retained income strategies such as charitable remainder trust strategies and charitable gift annuities. These are strategies allow the donor to retain some income interest for a specific period or life, the remainder at the end of the term goes to the designated charity. Let's go to the next slide. We'll talk about the charitable remainder trust first. The charitable remainder trust allows a donor to make a large gift to a charity while retaining the right to receive income from the trust for a period of time. At the end of that time period, the remainder of the gift is paid to the charity. The time period and percentage of income are defined at the beginning of the trust. The trust may distribute income for a fixed period of 5 to 20 years or over the life or lives of the named income beneficiaries. In general, income is limited from 5 to 50% annually. And the CRT must also pass actuarial tests based on the time period, life expectancies, and the interest rates to qualify as a charitable trust. One of the tests is called the 10% test, which states that based on the initial assumptions of the CRT, at least 10% of the amounts will pass to the charity. As a result of these tests, payment rates in excess of 8 or 9% are rare in the current interest rate environment. So basically what that's saying is, for this to qualify, you have to make sure at least 10% of what you've gifted to the trust in this income scenario goes to the trust. Less than 10%, it can be ruled not allowed. There are several varieties to CRTs that can be designed to help meet the donor's goals. They're either formed as charitable remainder annuity trusts, known as CRATs, or charitable remainder unit trusts. A CRAT is a fixed income interest of the initial amount, no smaller than 5% per year, and a CRAT is a fixed percentage, no smaller than 5% of the property donated to the trust, valued annually. In addition to the value of the gift to the CRT, many donors choose to use a portion of the income to fund life insurance policy for the benefit of their family members. Life insurance is designed to replace either partially or fully the full value of the gift to the charity. So when you make that gift, you're going to replace the legacy to your family by using some of that income that's coming back during the years to purchase a life insurance contract. For the donors considering large gifts to charities, charitable remainder trusts are a very popular tool. Donors are eligible for an income tax deduction based upon the current value of the remainder gift of the charity. Unused amounts may be carried over up to 5 additional years. So the actuarial table will tell you what the remainder of the gift to the charity will be. Once the trust is established and funded, the gift cannot be revoked. So you see on the slide here, considerations. This is irrevocable. You cannot change your mind. Because a CRT is deemed a tax-exempt trust, donors may be able to donate appreciated assets to the trust without liquidating and paying capital gains on them first. The charities receive the full asset value, not reduced by capital gains, and the donor's income tax deduction also reflects that pre-tax retirement. So if somebody heard about this company called, I don't know, Amazon when it first opened and bought it when it first opened, and now it's worth all the money it's worth, if you gifted Amazon directly to this trust or to the organization, you don't have capital gains, you don't have to liquidate it because they're allowed to accept the stock. You get the full deduction of the current value, and the charity now owns the stock and can sell the stock or keep the stock, but you get the full deduction value, or the CRT does, without having to pay capital gains. The trust then sells and reinvests the assets income tax-free. One drawback of a CRT is the charity you wish to benefit does not have access to the funds until the trust's terms. So depending on how long they need it. Next slide, please. Based on the terms of the trust, the CRT makes payments back to the trustee's designated income beneficiaries, typically the donors. This may be for a term of 5 to 20 years or over one or more lifetimes. These payments are subject to a 4-tier system of taxation that reflects the character of the gifted assets: ordinary income, capital gain, other income, and return of investment basis. Each tier will be taxed in the order above to the extent the trust has current year income or prior undistributed income of that nature. Only when the trust has exhausted income from one tier will it progress to the next, and so on. So it's going to be a higher tax rate to a lower tax rate over the life of the trust. Excuse me. Due to the significant value of most CRTs, potential donors may feel conflicted between providing this type of charitable gift and using the assets in question to provide a legacy to their heirs. Many resolve this internal conflict by using a portion of the trust payments to help pay premiums on a life insurance policy that will pay to the benefit of family members. Again, what I'm discussing here is usually on very large gifts and also part of an estate planning program. Next slide, please. Upon the death or the end of the CRT's term, any remainder balance in the trust is paid income tax-free to the designated charity. For the life insurance policy, the death benefit is paid to the named beneficiaries, typically family members, income tax-free upon the death of the insured. Life insurance death benefits would be considered part of the donor's taxable estate in the scenarios shown. If the donor's estates are large enough to be potentially subject to estate tax, or they feel strongly about placing conditions on future distributions, they may choose to have this policy owned by a revocable life insurance trust. I would suggest to you that people who are doing CRTs of any form are going to probably have estate tax issues, especially with what we're looking for at coming forward in the tax bills that are coming up this year. So most of them would have their life insurance set up in a revocable life insurance trust. Next slide, please. Charitable remainder trust. Charitable remainder trust is a very flexible and can be structured for many personal estate planning objectives, as well as to provide for your favorite charity. Because the assets ultimately go to a charity and not to your family, you should want to benefit charity, not just accomplish personal estate or income tax planning objectives. So you can't do it just for the tax planning. You want to do it because there's that want and desire that we all have supporting our most important charities like the Habitat. Charitable remainder trust can be structured to provide you with supplemental retirement income. You can use the trust to diversify your assets. For example, if you have a portfolio of assets, you want to change the allocation. In some situations, you can reduce taxes by using a charitable remainder trust. Grandparents may find this one strategy that can allow them to fund a grandchild's education with the income stream, and at the end of the term of years, the balance is distributed to the charity of their choice. In many cases, a properly structured charitable remainder trust can not only provide an income payment and income tax deduction to you, but ultimately provide a legacy to you and your charity. Charitable gift annuity. A charitable gift annuity is a contract between a donor and a charity. It is not a typical commercial annuity that you buy an annuity for. The charity agrees to make fixed payments to a donor over 1 or 2 lifetimes in exchange for the gift. The rates for the charitable gift annuity are suggested maximum payout rates and are determined by American Council on Gift Annuities. The calculation is made by the charity. The donor becomes a general debtor of the charity, and the gift goes into the charity's general fund. Theoretically, the charity has access to the gift immediately. However, many states require the charities to maintain certain reserve requirements to ensure the charity's obligations are met. The charity receives the remainder of the gift when the income payments end following the lifetimes of 1 or 2 donors. Each charitable gift annuity will have its own stated minimum donation. Charitable gift annuities are tools for donors considering significant gifts to charities, usually in excess of $10,000. I would suggest much higher than that, but have some concerns about their own life income needs. Once the donors make their irrevocable gift to the CGA, again, this one is irrevocable, they are eligible for a current year charitable income tax deduction. With a CGA, the donor's contract is direct with the charity. While other charitable strategies may allow donors to change their ultimate charity during the payment phase, it would be highly unlikely for a CGA. Therefore, donors should fully consider a commitment to the specific organization many years into the future. To the extent that a charity will accept non-cash gifts, making gifts of appreciated property to the CGA may donor to gift an asset without recognizing capital gains. Charity receives the full asset value, not reduced by the capital gains, and the donor's income tax also reflects that pre-tax amount. Even though donations are held in the charity's general account, various federal and state regulations exist that require the charity to maintain a portion of the assets donated to meet their payment obligations. For this reason, the charity's ability to use the donation may be limited during the lives of the donors. You want to make sure that if you're doing this with a charity, there are the resources that are received their obligation, similar to a form of a private annuity, but using it with the charity. Excuse me. Donor advised funds. Next slide, please. A donor advised fund is a charitable giving vehicle that allows donors to make contributions to a public charity, become eligible to take an immediate tax deduction, then make recommendations for distributing the funds to a qualified nonprofit organization on their own timetable. Donor advised funds are flexible options for charitable giving that have been gaining in popularity. While a gift is made to the DAF, is permanent and irrevocable, the DAF holds the gifts until the donor or the designated successors recommend grants to be intended charitable recipients at some point in the future. Gifts to a DAF can be made at any time. A DAF can also be named a beneficiary of a retirement account, life insurance policy, your estate, will, or trust. Each donor advised fund will have its own minimum gift requirements to open the fund and a grant amount. The donor will be eligible for the income tax deduction when the gift is made to the DAF. So essentially what you're doing is you're not making it to any specific charity today. You're giving the money to this donor advised fund, and then during your lifetime or your heirs' lifetimes, they will then make gifts to the different organizations as life goes on. but you get the deduction the year you put the money in the DAF. Highly appreciated securities are permitted to be given in kind to a DAF, so this enables the donor again to gift appreciated securities without liquidating them for the cash first, and having to recognize capital gains on the sale. The charity receives the full value, not the reduced amount, and the donor's income tax deduction also reflects the pre-tax amount. So assets that you've had a great appreciation and you do not want to face capital gains, this is a great way to minimize capital gains and give a gift of a higher value and get a larger tax deduction. A DAF may also be a way for donors to receive an income tax deduction for gifts to international charities. This option may not be permitted by all DAFs. Alternatively, grants to international charities may be subject to additional administration, may take longer to complete, and may be subject to additional costs. This option is important to you. Research the terms and conditions carefully with specific donor advised funds you are considering. Next page, please. The donors make an irrevocable gift of cash or property to the donor advised fund. Generally, the only form of non-cash gifts accepted will be marketable securities. The donor receives a current year charitable income tax deduction that may be limited by their adjusted gross income. Next slide, please. The donor advised fund sells the property income tax free and reinvests the proceeds into the portfolio directed by the donor or donors funded with the DAF grow income tax free until granted to the charity. So once the asset's been transferred to the fund, they grow income tax free until granted to the charity. This time or soon thereafter, you should put a succession plan in place for DAF funds with the administrator of the donor advised fund program. There are many options to consider. Examples include naming one or more successors to direct investments in future grants, or making a final grant of the account balance to one or more charities. The options available and what will happen to your balance if no succession plans are on file will vary based on donor advised funds you give to. Make sure you fully understand the fund's option and how your fund is set up to distribute assets following your death. Again, the planning is in great detail and you want to make sure everything is spelled out. Generally, additional contributions to the fund may be made in lower amounts than the initial gift. These additional contributions will also be eligible for income tax deductions. The donors or successors, if the donor is deceased, direct the grants to specific charities. Typically, very moderate grants may be made, $250 or less in some cases. There is no time requirement over which the funds of the DAF must be granted, so the DAF can continue for many generations to the future. Grants may be made anonymously or in the name of an individual or organization as in the memory of the benefit of. You may also name a donor advised fund as the beneficiary of any number of assets, including your retirement accounts or life insurance policies. When setting up the donor advised fund to accept these assets, you'll want to be certain to appoint your successors who will direct the fund's future investments and grants. Upon your death, your will, trust, account, or policy will pay the designated amount to the donor advised fund. The successor will direct the DAF investments. When the charity receives the benefit, the policy owner's estate will be eligible for an estate tax charitable deduction, which will be the value of those, the value to those with large estates to create a state tax liability. So if you donated $5 million of death benefit, you'd be able to deduct that from the value of your gross estate, for example. Next. Your successors will direct the DAF investments and future grants to charities. Grants can be quite modest, as I said before, and in many cases, there is no limit to the number of grants that can be made, provided the DAF minimum balance is maintained. Grants can be made anonymously or in the name of another individual or organization. There is no time required over which funds in the DAF must be granted, so the DAF can continue for many generations. Next. Something we'll talk about, which you're probably not going to see very much doing, but I'll cover it a little bit. Did you know that it's possible to charity to give shares of interest in your small business? In this strategy, an owner gives a minority appreciated interest to the charity. The gift is revocable and qualifies the owner for a charitable income deduction in the current year. The charity then proceeds to sell the shares or business interests income tax-free. The sale can be to the company, a key person, or an outside party. It just cannot be arranged prior to the charitable gift. This typically happens within a year or so that the charity is not forced to declare unrelated business taxable income, so the charity doesn't have a tax event. The owner or owners give minority shares of the business to the charity. In return, the donors are eligible for a charitable income tax deduction. If the income tax deduction exceeds the donor's annual allowed limit of 50% of adjusted gross income, unused deduction amounts may be carried over for up to 5 additional years. This strategy is often used in the process of transferring ownership to a key person or a third party. It may be attractive in that the owners may be able to gift the appreciated shares of the business without recognizing capital gains, but it may be challenging to find an acceptable buyer for the shares in the time allotted without it being prearranged. Be certain to use a tax professional, tax advisor when claiming the value of this deduction. Next slide, please. Small business owners make an irrevocable gift of the shares of interest in the business. For this gift, the donors are eligible for charitable income tax deduction. Be certain to use professional tax advisors when claiming the value of this deduction for tax purposes. If the income tax deduction exceeds the donor's annual limit of adjusted gross income, unused deductions amounts may be carried over a 5-year period. In the future, the charity sells the shares of the third party to a third party, typically a key person or other minority owner of the business, or back to the business, income tax-free. By way of selling the shares, the charity receives cash for their initiatives. This strategy can be a good way for philanthropic small business owners to include their favorite charity in their larger plans to sell or transfer the business. Charities are not capable of receiving profits from actively owned and operating businesses that are unrelated to their charitable purposes. The charity will be taxed on income received from such businesses. Therefore, small business interests are usually sold within 5 years of the gift. The income tax on charity is referred to as UBTI, the unrelated business taxable income. The charity's own tax and financial advisor must be contacted before an operating business is gifted to determine the potential income tax liability of the gift to the charity. My last point on that is, if you think about it, even though you do that, it's separate and it has to be done at arm's length. There has to be an understanding of where the potential buyer is and when that's going to occur. And it's really a tool to avoid capital gains tax. So a charity is only going to do that with someone they have a relationship with, and they understand the organization, and they understand, in theory, what the plan's going to be. Thanks, Rufus. Family Charity Balancing Act, replacing what you give to charity. Many individuals struggle with the idea that each dollar they donate to charity may reduce what is ultimately left to children or grandchildren after their death. In a worst case scenario, a charitable gift that is too generous can leave a family without the future income they need. Life insurance may be used to help ensure the family members are provided for according to your wishes. This can reduce fears over the family's financial security and give you the freedom to give as generously as you choose. Life insurance may be used to replace gifts to charity for family members. This is because life insurance can be purchased. The death benefit is generally income tax-free and is not subject to probate. In addition, an irrevocable life insurance trust may be used to own the policy. The trust may be drafted with distribution provisions, effectively allowing you to determine the terms upon which beneficiaries may receive your legacy. A life insurance policy that is properly owned by an irrevocable trust will also be excluded from the estate taxes for tax purposes. It is important to note that death benefits are generally received tax-free by the beneficiaries. It's not subject to probate. However, the amount may be included in the estate for the estate tax purposes unless owned initially by the trust. Also, existing policies gifted to the trust may be subject to a 3-year look back. I would like to thank Patterson Habitat for inviting us to speak to you today. I'd also like to thank each and one of you for valuable contributions you've made to Patterson Habitat. If there's one thing I would like you to take away, it's how important it is to work with skilled professionals when you're considering charitable donations. Having the right people on your team can help make the best use of the assets you have accomplished for all your financial goals, including the goals designed to help others. If you think we may be a good resource for your family, Please give us a call in any of these situations. Or if you just want to talk about the process or programming you are making towards your own goals. I look forward to getting to know you better, and thank you and your Habitat for the opportunity to provide this valuable information.
Thank you so much, Larry. I mean, this is probably the second or third time I've seen this presentation, so I wasn't jumping in with questions like I usually do because I've asked most of them already. But I am wondering, and I think it might be interesting, some of the folks on the call, if I own a fully paid for life insurance policy that I purchased, years ago when my kids were young, and I don't really need it anymore, the, mortgage is paid for, college is paid for. How do I go about donating that to charity? Do I just call up the insurance company and say, I don't want it anymore?
No, you don't go up to the insurance company. The last thing you do is call them and say, I don't want it anymore.
Okay.
You work with your financial advisor and the charity you want to give this policy to, and you would actually do a transfer of ownership of the policy from the person who owns it to the charity. The tax deduction is it's the interpolated terminal reserve value of the policy. Government rule, it's pretty darn close to the cash value. And I know I'm being recorded. So these words, pretty darn close. It's going to be a little different, and that would be what your deduction would be that the gift of the cash, the interpolated terminal reserve, or in this case, let me just call it essentially for this conversation, hypothetically, the cash value of the policy. So if you have a policy with a $200,000 cash value, $1 million death benefit, you're not making any more payments, that I gifted it to Habitat, my deduction would be probably that $200,000 subject to my AGI and everything else.
And then the charity can either take out the cash value or just hold on to it?
At that point, the charity can either utilize the cash value, wait for the death benefit, do a combination thereof, leverage the cash value. It becomes like anything else, like it was for the insured. It's now an asset of the charity.
Another thing to think about is if you want to make an even larger gift, people are living longer, and in the generally life insurance is getting cheaper because people are living longer. It all depends on your age and health and that type of status. But one of the things you could do is look to roll it into a new policy, and the ultimate benefit could be even larger to the charity itself. It all depends on circumstances. We'd have to take a look at it, potentially underwrite you, see if it needs any more cash to support it. But that is another potential thing to do with an existing policy. You can take it, roll it into an even larger policy, and make an even bigger impact with the charity you care to support.
Well, we actually just had somebody comment, and I was thinking the same thing, that there's a lot of information to absorb here in the last 45 minutes or so. So I'm going to be following up with everyone. If you want a copy of the presentation, is there any problem with giving that out, Larry? No? No? All right.
I have no problem.
No, I'll send a copy to everyone. And I'm sure everyone's going to have, or most of you folks are going to have follow-up questions. Like I said, we've done this presentation a few times, and within the next day, week or so, people tend to get back to me and say, "Oh, you mentioned this, you mentioned that. What does this mean? Who do I talk to?" So please, feel free to reach out, even if you can't think of anything right now, because we don't have any questions in the chat right now. What's coming to my mind, and I'm working with my father's going through this right now, is he has to take out his required minimum distribution. He doesn't particularly need it. He doesn't particularly want it. He certainly doesn't want to pay, any tax on it. So just to go back to that point that Larry made, if you're in that situation, please give us a call, because you can definitely send funds directly from your IRA custodian to the charity of your choice, hopefully Patterson Habitat. And the funds won't appear as a taxable item on your income taxes. So you're going to be getting some stuff from me anyway in the mail, but just to keep in mind.
And anyway, we can be a resource for anybody on the call or anybody involved with the Habitat. We'd be more than happy to be involved and help you.
Yeah, and if you, Rufus, is there contact information on here?
Let's see, I believe there is.
No. All right, well, I'll get that out with my follow-up email then.
Nope, doesn't appear to be. There should be though.
We'll
We'll
get it
have
to
to
you.
take care of it. Yeah.
I'll follow that. All right, well, if nobody has any more questions, I'm gonna let you folks go. Again, this was extremely informative, and I'm sure we all learned a great deal from your experience and probably have a lot of questions. As I mentioned, there'll be a follow-up email from me. There's going to be a survey coming out, probably by, what's today, Thursday? I'm sure you'll get it before Monday, just about the webinar. And there'll be a few questions in there on the survey about helping us plan future webinars. So if you have any thoughts about that, there'll be a couple questions. There'll be a fill in the blank screen. My contact information will be on there. Because what I want to do is talk about things that people are interested in. So sort of make sure I didn't forget anything from my notes. No, you'll be getting some information over the coming weeks about any, our upcoming webinars. This particular one will be available 5 p.m. tonight if you'd like to watch it again. Oh, something's coming in the chat here. Hold on a sec. Oh, no, nothing. So on behalf of Patterson Habitat, I'd like to thank everyone for attending, and I look forward to our next webinar. So have a good day.
Thank you all. Take care now.